Welcome to Master SIE Exam Vocabulary. Key financial terms explained. This presentation is designed as an educational resource only to help you understand the financial terminology commonly tested on the Securities Industry Essentials exam. Important disclaimer: the content you're about to see is for educational purposes only. This is not financial advice, investment advice, or exam preparation advice. It's simply a glossary to help you understand key concepts and definitions. Whether you're studying for the SIE exam or just want to build your financial literacy, this guide will walk you through essential terms in clear, straightforward language. Let's get started. Code of Arbitration. The Financial Industry Regulatory Authority Arbitration Code establishes rules for resolving disputes in the securities industry. Arbitration is an alternative to court litigation. A panel of neutral arbitrators reviews the case and makes a binding decision. The process is usually faster and less expensive than court trials. Many brokerage agreements require disputes to be settled through arbitration. At the open order. An at-the-open order must be executed at the market's official opening price. If it cannot be filled at that exact opening price, it is canceled. Investors use this order when they want exposure based on overnight developments. It ensures participation at the first traded price of the day. Institutional investors often use it to match benchmark pricing. Authorized shares. Authorized shares represent the maximum number of shares a corporation is legally allowed to issue. This number is stated in the company's corporate charter filed with regulators. Not all authorized shares are necessarily issued to investors. The company may issue shares over time for capital raising or employee compensation. Increasing authorized shares requires shareholder approval. Backing away. Backing away is an illegal practice where a market maker refuses to honor a quoted bid or ask price. Market makers are required to execute trades at their displayed quotes. Refusal undermines market fairness and transparency. Regulators treat this as a serious violation. It damages investor confidence in price reliability. Balance of payments. The balance of payments measures all financial transactions between a country and the rest of the world. It includes exports, imports, investments, and transfers. A surplus occurs when inflows exceed outflows. A deficit occurs when outflows exceed inflows. It helps evaluate a country's economic stability. Balance sheet. A balance sheet shows a company's assets, liabilities, and shareholders' equity at a specific point in time. Assets represent what the company owns. Liabilities represent what it owes. Equity reflects the owner's residual interest. It helps investors assess financial strength and debt capacity. Balanced fund. A balanced fund invests in both stocks and bonds. The goal is to provide income and capital appreciation. Bonds offer stability and income. Stocks provide growth potential. This mix reduces volatility compared to stock-only funds. Bank Secrecy Act. The Bank Secrecy Act requires financial institutions to report large currency transactions. Transactions over $10,000 in one business day must be reported to FinCEN. The law helps prevent money laundering and financial crimes. Institutions must maintain proper records. Violations can result in heavy penalties. Banker's acceptance. A banker's acceptance is a short-term credit instrument used in international trade. It is a time draft guaranteed by a bank. Importers and exporters use it to reduce currency and payment risk. It typically matures in less than 1 year. BAs can be traded in secondary markets. Basis point. A basis point equals 1/100th of 1%, 0.01%. It is commonly used in bond and interest rate markets. For example, 100 basis points equals 1%. Using basis points avoids confusion when discussing small rate changes. It provides precision in financial communication. Bearish. A bearish investor expects market prices to decline. They may sell securities or use strategies like short selling. A bearish market is characterized by falling prices. Economic downturns often create bearish sentiment. Investors may shift to safer assets during such periods. Best efforts underwriting. In a best efforts underwriting, the underwriter agrees to sell as many securities as possible but does not guarantee full sale. The issuer bears the risk of unsold shares. This differs from firm commitment underwriting. If minimum sales are not met, the offering may be canceled. It is common for smaller or riskier issues. Bid wanted. A bid wanted indicates a seller is seeking offers for a security. It is often used when there is limited market demand. Brokers solicit bids from potential buyers. The seller is not obligated to accept any offer. It helps determine market value in thinly traded securities. Blue sky laws. Blue sky laws are state-level securities regulations. They require registration of securities and brokers within the state. The purpose is to protect investors from fraud. Each state has its own regulatory requirements. They operate alongside federal securities laws. Bonds. Bonds are loans made by investors to corporations or governments. The issuer agrees to pay periodic interest. The principal is repaid at maturity. Bonds are generally less risky than stocks. They provide predictable income. Book entry. A book entry security exists electronically rather than in paper certificate form. Ownership is recorded digitally. U.S. Treasury securities are common examples. This system reduces risk of loss or theft. It increases efficiency in trading and settlement. Breakpoints. Breakpoints are sales charge discounts for large mutual fund purchases. They apply mainly to Class A shares. Larger investments qualify for reduced front-end loads. Investors should be informed about eligibility. Failure to apply breakpoints may be considered unethical. Breakpoint sale. A breakpoint sale is an unethical practice where a broker intentionally keeps an investment just below a discount level. This prevents the client from receiving reduced sales charges. It benefits the broker through higher commissions. Disclosure rules prohibit this conduct. It violates suitability and fairness standards. Broker. A broker executes trades on behalf of clients. Brokers act as agents rather than principals. They earn commissions for executing trades. They do not own the securities being traded. Brokers must be registered and licensed. Broker-dealer. A broker-dealer can act both as an agent and as a principal. As a broker, it executes trades for clients. As a dealer, it trades for its own account. It may hold inventory of securities. Broker-dealers are regulated by SEC and FINRA. Build America bonds. Build America bonds are taxable municipal bonds. They were created to fund public infrastructure projects. Unlike traditional municipal bonds, they are not tax-exempt. The federal government provided subsidies to issuers. They helped municipalities access broader investors. Bullish. A bullish investor expects prices to rise. They may buy securities anticipating gains. A bullish market shows upward trends. Strong economic data often supports bullish sentiment. Investors increase equity exposure in bullish periods. Business risk. Business risk refers to the possibility that a company's operations underperform expectations. It can result from poor management or competition. Economic conditions may also affect performance. Business risk impacts stock value. Diversification can reduce exposure. Buy limit order. A buy limit order instructs purchase at a specified price or lower. It protects investors from overpaying. The order may not execute if the price is not reached. It provides price control but not execution certainty. It is commonly used in volatile markets.